Got to turn to the banks. Big deal recently. The latest report is that the SVB stock sale has failed. All right, got that. Gregg Smith with us this morning. Your job, Greg, this morning is to explain the danger with SVB. Is it another Lehman moment?
Hey, good morning, Stuart. Look, I think investors are waking up wanting to know the answer to that question, and I don't think this is a Lehman Brothers moment. Okay. I think in the weeks ahead, we're going to look back and realize this was what I'll call an orthogonal event to the rest of the financial services sector, which, you know, their balance sheets are in terrific shape today versus where we were in the financial crisis back in 2008. But what I will say is this has all the makings of a Bear Stearns-Style take under. And as you recall, Bear Stearns was taken under at $2 a share. And I'm going to tell you why. So I think this company has an unquantifiable book value. And as you know, book value is a very important measure with financial services stock. So I would challenge you, I don't think there's a sell-side analyst or anyone even in the C-suite of Silicon Valley Bank that could tell you what their book value is today. So the reason for that is really has to do with the loans they make to tech startup companies. I know the whole market, I think, has it wrong in the last 24 hours is looking at this bond sale and them trying to lower their interest rate or get a better rate. But it really has to do with the quality of the loans that they have on their books. Okay. As you know, this is a storied franchise that has been a foundational company on Sand Hill Road, making loans to tech startups. They are loaning money to companies that could not walk into a traditional lender like a JP Morgan or a Truist Financial or even a sharp-elbowed hedge fund or even Tony Soprano. Tony Soprano would laugh at many of these companies if they came to him to borrow money. So what's happening now is in the downdraft in venture funding, there's probably a $100 billion shortfall in need by venture-backed startups for capital that doesn't exist this year. So SVB is a bull market lender. They have extended loans to companies that are losing money, probably have less than 12 months of life left, and those loans are going to perhaps go to zero if they can't be repaid.
Got it. Greg, thanks for the explanation. We appreciate that.
You're welcome.
Canary in the coal mine, maybe. All right, Gregg Smith.